Okay, everybody, welcome to a brand new episode of the Speculators Podcast. We all know that as traders, our primary job is to put capital at risk and then to make sure that we're managing that risk. In this episode, we're going to be talking about risk management, the idea of the opportunities in the market, balancing that with the risk involved in the market. This is a topic that is brought up in virtually every single episode that we have. And so in this episode, we have put together a supercut, going back to some of the heavy hitters and some of the amazing guests that we have had on this channel and revisiting these topics of what are their best advice around risk management and their how they perceive the opportunities in the market, and of course how we strike the balance between these things. I know you're going to love this episode. I was very happy that we were able to put this together. So kick back and relax and enjoy. And welcome to this newest episode of the Speculators Podcast, where we're going to be talking about risk reward, opportunities in the market, and striking that balance. From your perspective, actively intraday trading exclusively, nothing longer term, trading futures, is it realistic, and does the scale work to where this could be $1 million a month business?
Yes.
Yeah. 5 million?
Intraday trading, the most liquid futures products, yes. Now, if you were only, like you just wanted to trade nothing but outright, let's say corn futures, right? And they're on my list of 14. They're one of, the top kind of liquid ones. They're not like S&P, obviously, but you're going to run into issues there, right? Like it's the thing you run into is hiding. You have a harder and harder time hiding, and that becomes problematic. You start to need ways of disguising what you're doing, spreading it out, randomizing clip sizes, perhaps even using different accounts. Because it's a competitive space. Like if people can identify you as a player, think about like, when there's been different runs on different firms or, cornering different markets or people getting squeezed out of things. Like this is what markets do. And other participants want, to kill you. So, you and I don't necessarily feel that way, but like the big, that's the design of the game, is to extract money from each other. So that's the big thing, is keeping that level of anonymity is a big deal, because there's size there's great all that good stuff.
People should have two sizes. They should have their normal size, and if the stop has to be far away so that the normal size requires them to risk more than 2 or 3% of their account, they need a second size. And I wouldn't have a third or fourth or fifth size, or I wouldn't treat it like it's on a sliding scale. To me, you have two sizes: your normal size, and if you don't take a trade because you're afraid, you have a second size. And how big is that second size? I recommend 20% of your normal size. So if you normally trade 5 E-minis and your stop has to be too far away and you don't want to take this trade, then you would trade 1 E-mini. You don't spend time thinking about, should I trade 2 this time? Should I trade 3 this time? That's a distraction, and that's a sign of weakness. And whenever you let yourself get distracted, if you're in battle, if you're distracted, you're gonna get killed, right? When you're trading, you have to be as mechanical as you possibly can be, and you want as few moving parts. And you can say, okay, if I trade 1 E-mini, I'm not going to make much money. Right, you take 1 E-mini, and if the market goes, let's say you buy, let's say it's a buy setup and you buy, and the breakout is very big. You trade 1 E-mini, and then let's say the market goes up the size of a scalp, and the E-mini now scalps are about 5 points. Okay, and then you get another bar closing near its high. What do? You buy more. And then let's say a few bars later, you get another bull bar with a decent sized body closing near its high. What do? You buy more. So you're scaling into a winning position. And, you were not able to take the 5 contracts initially, but you might get up to 2, 3, or 4 contracts. And given that since the bars are big, you could still end up making as much as you would on a normal trade where you would trade 5 contracts. When people are not making a lot of money, all they think, especially if their account is small, they're thinking about one thing: risk, losing money, blowing their account, losing their dream of becoming a successful trader. So the fear of death of their dream as a trader. Okay, that is what is going on. And you got to get past it. And the easiest way is trade the I don't care size. So you got to get down to a size where if you lose, say, my dream as a trader is not going to die. I'm going to be okay. And if you do that, you'll start catching more of those trades, and you'll make good money. All right. As I said, 20% position. But if the move is, if the profit that you make is 2 or 3 times what you would make on a full size position, you still come out pretty good.
When somebody's trying to, let's even say, learn how to trade, I think that most of the common wisdom out here is not good in terms of thinking about things like I'm going to get 1-to-1 risk to reward, or I'm always going to use this much size, or I'm always using this much of a stop. And these very binary decision makings, we can just do so much better as traders. But this requires trading skill. Do you think that right from the rip, there's benefit in treating things not ideally in terms of focusing on 1-to-2 risk to reward and then just cutting off? Or do you think right off the rip, people should just be focusing on those skill sets and making those decisions that they need?
I think it's a mixture of both. And I know that's probably not going to do the viewers much of a positive one, but I think when it comes to managing risk, be precise. Okay, I think risk needs to be precise simply because in the beginning of your career, you have to think of it. You've got an amount of rope. Okay, and think of your rope as your amount of time effectively. And every day you spend in the market, you're using up a little bit of that rope. Okay, now the reality is that none of us have infinite capital, and you have to safeguard that capital, which means if I'm in the first 2, 3, 4 years of my career, I need to learn as much as quick as I can, as cheap as possible. That's kind of your objective in the beginning. And then hope, obviously, you come out on the other side having enough skill to be able to break even and make some money out of this. So yeah, I'm a firm believer in terms of the risk side of things. To answer your question, I think you want to be precise. I think you want to be exact. You don't want to, you want to keep it simple, obviously, but I don't think you want to go, I'm going to be long and then I'll kind of just, maybe I'll get out here, or maybe if it closes below you. I think that invites too much discretion and just problems as a result. Whereas on the upside, I think you've got to steer very clear or very far away from, I'm going for a 2-to-1, 3-to-1, 4-to-1. I think that's something that's very misleading. It's very much driven by marketing. If I was to tell you, hey, sign up for my course and I'll teach you how to make 3-to-1 risk reward. Okay, it's a very, very easy marketing term. The reality is, ask any day trader to see their playbook and you'll probably find their risk reward is probably short of 1-to-1. Okay, if you go and look at all their trades over time, it's probably definitely less than 1-to-1, which will come as a surprise to most people. Okay. Don't forget, if you were just to draw a distribution curve of any strategy, so take a very simple strategy and go draw a distribution curve of the excursion, in other words, the positive excursion and how favorable that trade can look from a target perspective. What you'll find is that it's very far into the right. In other words, the really big winners from a distribution perspective happen 1%, 2% of the time, whereas the 1-to-1s happen frequently, 40, 50, 60% of the time. So just looking at pure basic statistics, you've got to be realistic. You've got to say to yourself, if the market's offering me 1-to-1, 40, 50, 60% of the time, that's probably what you've got to be looking at in terms of target. Okay. You've got to leave the 3-to-1s, 4-to-1s, 5-to-1s for, I think you just got to leave those alone. Not because they're not possible, but because I like to think of those as the ego trades. They're the ones that when you do get it right, cool. All right. You're not going to be doing it on any size. You're not going to be doing any leverage. It's that one that you run the one lot for and you feel like a hero and you tell your wife about it because you're so proud you sat in the market for a week. But the reality is that's not where traders make their money. Okay. Traders make their money on well-positioned, well-timed trades where they've got not oversized leverage, but they've got a good enough amount of leverage that they can make some decent money. Okay. Again, if you look at a trader's P&L and you go and plot their P&L dailies over the course of the year, you'll see 10, 15 really big up days, and the rest are all very average. Okay. And this is the same for million year traders. They don't make that million by making 20, 30, 40K every single day. No, it comes very much with a couple of outlier days, and the rest are sort of just average days. Okay. So again, I think that probably does, for new traders particularly, get that idea out of your head, that 3-to-1, 4-to-1, 5-to-1. I think the reality of the situation is you're not going to get those winners as much as you think.
Incredibly powerful topic right there to go on. And the what we're diving into here is the reality of what the market looks like when you get out of this, on paper or in theory, but when you actually get into the raw market, the reality is those trades where you enter and they go straight to a 5-to-1 target, those are the outliers. And what it actually looks like of the process of entering a trades that fail immediately, or entering trades that go partially to your target and then something changes, or making up for all of those variations, where are the meat of your trades going to come from realistically? And it is not, I'm going to enter here, exit here for a loss, or exit at this 5-to-1 target. That's just not what it looks like in real life.
I think demo accounts are great. If you're about to put $1,000 in the market, in my opinion, it's like, stop, just don't do that. Trade demo account. Take it seriously. I hate that it doesn't have real money. I don't treat it. It's like, just decide to treat it seriously. I get it's not as emotional, 100%. Nothing is as emotional as when you have 100 grand on the line or whatever. Right. We're not there yet. You're new. Start with a demo account. So I really hate the people that push trade penny lots. I just think it builds bad habits. Everything in trading, in my opinion, again, just opinions always, should be based on risk percentage. Okay. We have a stop loss of 10 points. We're going to risk 0.5% on this trade, 0.5% of the overall account balance. It's risk-based. Whatever lot size that is, great. That's based on the overall account. So to be like, oh, I only trade 0.1 lots. Whenever people talk to me about I only trade this much size, I know they're an amateur trader. I know they just have no experience yet. They haven't learned. They haven't had enough years. It doesn't matter. The lot size is only based on the account size. And if you have too small of an account, you will be trading these small lots, which again, I just think it's insignificant. Okay, you made $4 today. No one cares. Like if you make $4 today, you won't just stop trading. Whereas if that was a big account and that was your one trade and it was a good trade, you could have made $4,000, you would stop and that would make sense. But because it's $4, because you're trading a small account, you're going to keep trading today because you want $50 today and it'll be a good day. That's not trading. You know what I'm saying?
I know exactly what you're saying. And I think that there's an old saying, the rich get rich and the poor get poor. And one of the reasons for this, and we talked about biases at the very beginning, but our biases are they control us like crazy. It's unbelievable. And when you feel like you have something to lose, you will behave very risky. And if you feel like you don't have something to lose, you feel like you're good, you act completely different. And somebody that has a lot of money, they're not chasing around weird little crypto coins and doing weird stuff because they're good. The people doing this stuff, they're starting every day kind of with a sense of loss. They got debt, they got bills they can't pay, they're not living the life. Every day for them is a day of loss. And so they do really risky, weird things. And this is a fundamental difference between trading and just gambling, of trying to take that small account and just, run it up out of nowhere. It's like buying a lottery ticket and trying to hit the lotto. That's it. As opposed to being able to, actually trade and be in a position where you can make a meaningful, not that you have to make a meaningful amount of money right away, but you can be in a position to behave in a way, and then you can scale that up.
Treat it like a real business.
A very small amount of money and just, that's
right. Exactly.
We talked about this idea that you had the markets here and this number that if you reach that, everything kind of opens up for you, or at least it really changes the quality of your life. And I've had a very similar realization recently of just this opportunity that we have to sit down at this computer, and the computer can be anywhere that we want. And there is the potential here to make $1 million a month. Like it's there. It's the ability do we have to tap into this. And it's almost like the story of the Garden of Eden, where Adam and he was in this environment that was just everything he could have possibly needed and wanted. The only thing he really had to focus on was don't mess it up. And we have this environment in our trading. And one of the primary thoughts that we have to keep is just don't mess it up. Don't do anything that's going to stop us from being able to do this again. And don't do anything that removes this from our life.
And if we can do the right things and just not mess anything up, we get to stay in paradise of sorts. But there are a lot of trees of knowledge of good and evil that if we, tap into those things, we lose the ability to keep doing this.
Dude, you nailed it. Yes. Let's go, Mike.
Yeah.
Yeah. I like to call the stock market an ocean. Man, it's huge. It's massive. It's all encompassing. It's organic. It moves in waves. And like you said earlier, the market wants to take everything from you, including your life. Sure. So does the ocean. Ocean's perfect. It's beautiful. It's pristine. You can play in it. You can swim in it. If you're in the ocean too long, you will die.
Yeah.
Just the way it is. Doesn't matter if you're the greatest athlete in the world or if you're on a ship. If you stay out there too long, it's going to take your life. Trading is the exact same way. And then from the standpoint and the analogy of vastness and abundance, right? The stock market is the ocean, right? If you go to the ocean and take a big, whatever, pot of water, bucket of water, you take that water home with you. Did you take water from the ocean? No. It's so big, doesn't even notice. Every single person on earth could do that every single day. Nothing would change. That's how large the ocean is. It's massive. It's going to get refueled by the water cycle over and over and over and over and over. That'll never change. And when we think about the way of the market, you can go in, like you mentioned, $1 million in a day, $1 million in a month, $1 million in a week, $1 million in a year. It doesn't matter. It's all the same to the market. Just Tesla, one of the reasons I trade it, $84 billion a day goes in and out of Tesla per day. That's $250 million every 80 seconds. It's a lot, dude. That's a lot. $250 million, right? Every 80. So who are you not to make whatever amount of money? If you made $1 million in Tesla in a minute, you wouldn't even show up on the radar. You didn't even buy a ticket into the room. You're not even on the screen if you made $1 million in a minute. Dude, that's an amazing concept for me to think about. And when you're talking about the scale of abundance, it really just stretches your mind and lets you realize you're not that important. You think you're more important than you are in the grand scheme of the market, but it's like the market is all encompassing, it's all knowing, it's all powerful. Enjoy it, play in it, be in it, make some money, do your thing, and then leave and then go enjoy the rest of your day, the rest of your life.
Almost to a person, they had a lot of emphasis on how important risk management was. I mean, it sounds like a cliche, but it's basically true. So most of the people I interviewed would insist that their success is more a product of their risk management or their being disciplined in their risk management, as opposed to that they were brilliant, they saw things other people didn't see. It's not, they would say it's not that. It's not that they had particularly insights that were just unique. It's that when they were right, they executed and were able to stay with it, and when they were wrong, they were able to act quickly to avoid any significant damage. That avoiding significant damage when you're wrong is the difference between professional traders and amateurs. Wow. Because people who don't do that, it's just a matter of time before the trade comes and knocks them out. So I can't tell you, I mean, who knows how many people have done well up to a point and then blown it all on one or two trades. It happens all the time. And if people listening to this podcast can get one thing out of it, is just the most important thing you can do in trading is make sure you don't lose a substantial amount on any single trade or idea. That is the most important thing, and that will go further than almost any other advice anybody could give you.
Is there a question that you wish I would just go ahead and ask you, or as you're even on social media, do you find that there's like a topic that you wish people talked about more?
Risk management. I think that's a crucial part of it. I mean, on our desk, we say start with your stop. Like, you don't really have a trade until you understand where your stop is. And your stop typically isn't like at least with the way we trade, it isn't like a general risk reward component. It's not, I'm going to risk 1 to make 3 and wow, that worked out so well. It's actually the price actions telling you where your stop is and where you're wrong in the trade. I think that's a giant component to risk management, because the reality is you don't really know how much you're risking unless you know exactly where your stop is. I think that's a big thing that I wish more people were talking about. And you don't really hear that as much as I think we're starting to hear more of it, which is exciting. But that's a big thing on our desk, is make sure that you, first of all, understand what your edge is. But then even from an execution perspective, you have to see where your stop is, and you have to understand why your stop is there before you even get to the point where you're entering a trade. Because if you don't, then your sizing is probably going to be completely off and you're more prone to making a mistake. Maybe if the trade doesn't work out exactly as you wanted, but isn't doing anything wrong, that can be a big problem. So I wish more people would talk about that, but let's be honest, nobody's gonna click on that. It's not very fun. Nobody talks about their driving. What do people drive now? Lambos? Is that the thing on Twitter? I'm so like against everything Furu-ish. Because
start with your stop.
Really, really hard. We worked really, really hard at being good at trading. And and even the really successful traders we have on the desk, even everybody works really hard at being a good trader.
If you can build a process where your anchor every day is, I want to see if I can position myself so I lose the least. If the wheels come off the bus, you're going to be hitting the gravy train sooner than you realize. It truly is. Management of risk is just so important.
What are your thoughts on this? Do you think it's a good idea to risk the same amount for every trade that you take? Or do you think it's an important skill to know when it's time to hit the gas and when it's time to throttle way back?
100% B, right? Never keep your risk exactly the same, right? It's not, listen, if you have a mate and they live with you in the house, some days you go, I got to give them a little bit more room. They're not feeling it. Or you think to yourself, I need a little bit of room, right? And the market is the same way. It's a fluid organism. So the key event about trading is, and listen, this is a tough skill to build. This is one of the toughest skills to build. Oh, I'm just going to risk 5 points. Oh, I'm just going to risk. Well, what if the market's telling you it's got 10-point risk because they've come in and the wicks are bigger or whatever? If the market is telling you something and you don't have enough insight to look at that and go, those candlesticks are a little bit bigger than normal. 5 points risk is not going to be able to do it for me today. I either need to be extra cheap, getting myself on the buy side, or I got to go, all right, I'm just going to, sit this one out and wait until the risk parameters are mine. But my risk changes with every single trade. Every single trade I will go, okay, last time it looked like 5 points. This time it's holding a higher low. I'm going to use 4 points if it comes back into that same spot. Yeah. I'm just going to tighten it up as the formation builds its own structure, right?
Yeah.
As a structure forms, you get a better feel of, it's not going to go over there. And if it does, swerve, right? Totally out. And so that's kind of, that's how I will do it. It's very, very fluid.
Sure. Yeah. It's so natural to just want to crave certainty. And I just want to do this and I just want to get this result. And learning to, I think, not just be okay with it, but just embrace, like, this is the environment that we're in. This is not the environment for certainty. This is the environment for uncertainty. And if you want to fight that, or if you're not comfortable with that, this is just really not the space. But if you can learn to enjoy that and realize, like, this is what makes this special, and and enjoy it, then you can make these kind of moves.
What would your advice be to a trader who feels like the market is just out to get them? Feels like if I'm thinking about getting in the market, it seems like when I get in, that's immediately the market turns against me. If I kind of get out of the position for a loss, it immediately starts coming back. If I feel like I'm going to stay on the sidelines, the market goes perfectly, exactly where I wanted it to. And they're kind of left with this feeling that somehow the market is targeting them and the market is out to get them.
Yeah. So firstly, I would say is they need to come to a realization that they're completely wrong about that. Obviously, the market is not out to get anybody. The market doesn't know or care about your position. And I always like to tell people when they ask, like, what is the market or what are we doing here? Always think in terms of the fact that the market is an opportunity machine. That's all it is. Every day when I wake up, I come to the market, I'm super excited. And 9 times out of 10, I don't even know what the opportunities are going to be that day. I let the market present them to me. And because I've been doing this for a while, I act without hesitation. It doesn't matter to me. I actually had this conversation with my subscribers very recently. I said, maybe you guys think that I spend hours at night poring over the charts to find these high probability setups that we can do together. But I said, I don't really. I come to the market relatively cold and just in a very open mind state. And I let the market tell me what to do. Obviously I have a handful of stocks that I'm looking at, but depending on how they're acting is what I'm going to do. So also more specific to what you're asking about this newer trader is I would probably tell them to either ratchet their size down to 0 and look at things in a simulated environment, or ratchet their size down to some very tiny size that will not affect them at all if they stay in the trade and just let it play out, right? But a lot of times what happens in your example where, person has bad location, they get in, they get out too quick, or they get out and then it rips in the right direction. I feel like I can't speak for everybody, but they're probably nervous. They're probably nervous about losing. So you need to get that to a place where you're not nervous about losing. And that can only happen 2 ways. It's either sizing down dramatically or just looking at it simulated in like a paper environment. I'm a big believer actually in the paper environment, as long as you keep records. I think we might have touched on this in the first time because I've said it a million times. If you keep records and treat it like it's real, then that's fine. But the main thing is that as the market's unfolding and you're in the position, whether it's small or no position, what you want to be doing is collecting information on how the market moves and what the market is doing to your position as it's doing its thing, right? This is something that comes up all the times, much more so, I think, in options trading than in futures trading, because in options trading, there's so many different variables, right? So I always tell traders that it is absolutely invaluable to, for instance, put the position into a monitor tab as if it was working, right? You just have it in an analyze portion of your platform, or maybe you have it as a working order with some ridiculous price that'll never fill, right? This is extremely valuable because you see it sitting there. You say, okay, I'm interested in this butterfly, but it costs $7. I don't know if I should buy it or not, and the newer trader is going to hesitate a lot and say, oh, well, that's $700 a contract and et cetera, et cetera. Okay, so use it as a learning experience. Put the butterfly there in the analyze section, and now just watch. Oh, okay, my stock went up $2. Okay, the butterfly went up to 730. Oh, now the market tanked the next day. The butterfly went down to 580. You see what I'm saying? It just becomes this exercise of watching and learning over time, so that when the trader then puts on the actual position, they are less nervous, right? The only way to get rid of these nerves, or to get rid of nerves in anything in lifetime, if you think about it, is just to do it many times, right? It's to actually see it and do it many times, right? Everybody's nervous about everything the first time, right? We've all been probably nervous the first time we, fill in the blank, right? But then once we do it 20 times, then it becomes rote.
When you focus on like your risk to reward, are you happy with like 1-to-1 risk to reward that you're going for? What's kind of like your idea or your thought process around it?
So that's also based on the particular trade. Obviously, ideally you don't want to be risking 3 to make 1. But it has more to do, again, with adapting to the price action at play. So if I'm taking a trade for, like, let's say I think they're going to run to new highs and they do, then I just try to give it room to run, and maybe I'm going to get, based on my initial risk assessment, maybe I'm going to get 3-to-1, 4-to-1, 5-to-1 on that kind of a risk to reward, or reward to risk. Whereas if it's more of like a range play, then it's going to be like 1-to-1, right? Like maybe I should have kind of the right area. And if I don't, you take a 3-point loss or 3-tick loss or whatever, and I'm only going for 3 ticks because that's what the range is, or like maybe the range is 4 or 5, but I'm maybe only going to go for 3 of that. And then I'm going to risk 3 if I'm wrong, if it goes through me. So again, it just depends on the particular setup and the price action.
Yeah, that actually surprises me that with 40% winners, do you when you put a trade on, then
mid 40s,
yeah, interesting. Because I often think I go for a higher win percentage right now, and right now the market's not been great through July for me, so I'm a little under 70%, like in 60s. But typically it's fairly common for me to week be somewhere around 70, sometimes higher than this.
What about the other side of the expectancy formula for you? Like what is your actualized risk reward tend to look like?
My risk to reward, a lot of times I'll take it if it's just like 1-to-1.
I figured, but typically, there's no free lunches, right? Typically someone with a higher win percent is sacrificing risk reward, right? And that's the thing. That's the cool thing about trading, is that there's not one way to do that. There needs to be an understanding of what we're talking about here by nature. Not that I'm saying that I'm better than you at all or anything like that, but by nature of me approaching the market the way I am with a lower win percent, the lower win percent is the reason how I'm able to have higher 2-to-1, 3-to-1, 3.5-to-1, sometimes a 12-to-1, right? Like big risk reward. Whereas if I were to say, hey, I'm going to go a lot of times take 1-to-1, maybe even a little less than 1-to-1, that win percent, right? It's like you can't have them both. You're never going to meet a trader, an honest person, who says, yeah, I'm 75% wins and 4-to-1. No, you're not. It just doesn't exist.
Yeah, it is interesting because I've had this thought with myself of, and I would actually be interested in your input on this, if my niche, like the thing that I'm just better at in the market, is being accurate, getting in, getting out, not going to see very many of my trades go, like let's say on the S&P, go over like 9 points, but not letting a lot of things roll back on me, getting those scale outs, even trade ideas that don't really work, I'm still bringing something in on those. As opposed to dealing with, or if I would actually be making a lot more money if I could get over that fact of struggling with being right, or going on tilt when things aren't working out, and just be more at peace with it. And it's almost, I don't know if it's like a growth thing for me, to where an evolution of my trading would actually be to hold on to these things longer and to not micromanage them. And also I would say one of my biggest issues has always been over trading. And so, I'm actually
most situations, over trading, from my experience, over trading comes from exits, not entries. People are looking at the chart and they're like, I overtraded. I got in at too many different places. And in reality, what's going on is that they were emotional about an exit, and they have this longing to be back, to have that position back on. And so then they're putting themselves in a compromised position, because now all of a sudden they're never going to get that great trade location that they originally got. And now you're chasing it. Anyways, just a quick thing there.
Yeah. No, you're exactly right. And it's interesting how many things are something on the surface, and when you really drill into it, it's just like a whole different thing that's actually, causing this issue. But anyway, I would be interested, just as, and you might not even have enough information to speak into this, but do you think that in most situations, it's better just to identify that, hey, this is kind of your natural aptitudes, and it seems like this is where you can thrive more, and those abilities to have, some of these trades go 9, 12 points in your favor and then roll all the way back on you, you just can't handle that. So, lean into be a little bit more scrappy, or, if you want to evolve as a trader, you need to be able to capture some of these bigger moves.
If I can collect my thoughts there, I had so many while you were laying it out there. Number one, it's really important to really dig deep and find out if, and it's typically only one way, if your scalpy, quicker exits, peeling off risk pretty quickly, you have to search and really, really, really come to the truth of, are some of those done out of discomfort avoidance, right, emotionally, or are those done in more of a process-driven, tactical, repeatable type way, right? because a lot of people will go about a more scalping approach under the guise of it's my niche, when in reality, they could never move past what is one of the hardest things in trading. Everybody from Jesse Livermore to, us here present day talking about it is holding trades, right? So I'm not saying, that I don't claim to know which of those it is. My recommendation is for you and everyone else who's there to really search yourself and try to find out. And it could be, there's some signs. So for example, I was working with a guy the other day, and you see these clusters of exits around the same area. Okay. When prices it's reached an area, he took a scale. That doesn't tell us any information from what I'm about to say, right? That's just like a normal looking thing. But then if it kind of moves around in that area and you take another one, and then maybe there's a little blip or whatever, and you take another one, to me, that says emotional trading. I say, hey, point to the process behind you taking those scales. And if the guy would have been like, oh yeah, if the market stalls within 0.25 ATRs in the session for at least 8.5 minutes, I'm required to take another scale. You know what I mean? But no, that's not what they said. So it was really enlightening for them. They didn't realize that they were doing that. So that's the first place, is to search yourself. And I guess the prerequisite there actually is to have a process and know a process. Where do you take your best scales with market generated information, right? Like, what does that look like? For people who are really touchy-feely on the tape, it gets tough because you see all these little blips. I think being touchy-feely on the tape in terms of trade management, beyond an initial scale and beyond looking for direct momentum or something, is actually a mistake. I think by the time you've taken a scale or two on some direct momentum, you timed the trade really nicely, I think it's time to zoom out. I think it's time to come off of the dome, to come off of the footprint, come off the cumulative delta, come off speed of the tape or tiny little bar-to-bar candlestick action, zoom out. What was the idea for this trade? Where is it? Is there any more major potential left for it? Things like that, and to approach it differently.
It all goes back to the original thing I was saying earlier. Develop process. That's what you have to do. You're not going to believe me, okay? But I'm going to say it, and I've said it a million times, all right? You are not going to make money over time doing this by being smarter than everybody else. It's not going to happen, right? Because you may be, I've said this a million times, you may be the single smartest person out there. I don't know. Maybe you are. Maybe one person is that, and maybe it's you. But you have to be smarter than the entire market combined in order to do that. And that's simply impossible, right? Einstein wasn't that smart. Nobody's that smart. You're not going to be smarter than everybody else combined, because that's what the market is. The price of an asset in the market is everybody's opinion of where the market should be right now, right? So how are you going to outthink that? You're not, right? So you have to get over that idea. You have to get over the idea that making money in the market is about being right or wrong, okay? Because it's not, okay? This is gambling, right? So with gambling, you have to be able to identify where there's a good risk return bet, right? Be disciplined enough to put that risk return bet on, understand enough about risk management to size that risk return bet properly, right? And over time, do that. That's how this works. That's what this game is. This is not about the 50-day moving average, okay? It's just not, all right? This is not about, I know what the economy is going to do. It's not about that, right? It really isn't. I know everybody wants to believe it is. And I know if you watch TV and you read the financial press, and that's what it will look like it is. But it simply is not, right? And I know you read these guys and, oh, look at this guy. He got it right. He's a guru. No, okay? He flipped the coin and he got heads. That doesn't make him a guru, okay? The market's either going to go up or down. And you're going to say it's either going to go up or down. And if you said it went up, it's going to go up, and it did go up, that doesn't mean that you saw the future. It means you flipped the coin and you got it right. It doesn't mean a damn thing, okay? So, and you see that now. All these guys that were right about the bear market in 2022, and they were heroes, and now they're all wrong about the bull market in 2023, and now they're jerk-offs. They're neither. Okay. They're just people making guesses, right? And that's the point. You have to be able to make money by guessing. And that's all about risk management. This game is all about risk management and discipline. The rest of that stuff is all a bunch of malarkey and will kill you and will make you lose money. So if I'm going to give someone advice, find a process, right? Backtest it. And backtesting has its downfalls as well, but it can help, right? Test this process. And I mentioned the 50-day moving average. Hey, maybe I'm wrong. You know what? You think the 50-day moving average is great? Okay, then test what 50-day moving average trading system does, okay, and see if it's any good, right? Don't buy into the bullshit just because a whole bunch of people are talking about charts and moving averages and resistance and support. You can't just buy into that because you think it sounds cool, right? And because it's easy to do, right? Test it. See if it works. Develop a process. Stick to that process. That's where you're going to make money doing this. That's the only shot you have making money doing this.
So that brought into mind, or crystallized the whole idea of the risk reward ratio. I don't know what that is. Somebody had asked me what my RR is on Twitter not long ago, and I actually had to Google it. This like a year or two ago. You know, when I started to become popular on Twitter, I had to Google it. What is that? I don't know what. Am I going to risk 4 points to what, make 8? You know, so that's, again, I don't lose money. I have expenses. So I'm going to risk a couple of ticks to make whatever the market has for me, 5 points, 20 points, 50 points, 100 points, whatever. You know, caught that break last week and I'm still short some. And I didn't risk much more than a couple of ticks on an 8 line. So I don't know. I think that there's wisdom in a lot of those sayings. I think that the trend is your friend. For there's some wisdom in it, and I don't fight trends anymore. I don't fade markets. There's a lot of them. They come to mind when I'm talking about it, and they're it's just not coming to mind now though.
Yeah, no doubt. It's very interesting to hear you say that. Just I think a lot of people will hear not paying attention to risk for reward and maybe take that as the risk doesn't matter. But just to I am constantly, I'm sorry to interrupt. No. I am constantly amazed at the amount of traders that don't use stops. I mean, like, it's shocking to me. How do you not? I only have 2 rules. Everything else is a guideline. Use stops on every trade and pay for every trade to remove my risk. That's it. Everything else is a guideline. Holy smokes. HODL. Oh, okay, now they're rushing in. HODL drives me out of my mind. What is HODL? Oh, hold on for dear life? No, you can't eat paper profits, but you can sure fucking choke on them. Excuse my language. You can't eat paper profits, but you can sure choke on them.
I just hated losing. I really hated losing money. And it's not about winning. Right? It's not about wanting to win. I mentioned this recently in my thing. You don't win as a trader. You never win as a trader. Trading is an infinite game. You can't win in an infinite game. In an infinite game, the goal of the game is just to stay in the game. That's it. You can't make a lot of money today and say, yeah, I won, right? That's not it, because we have to come back tomorrow and do it all again, right? So it's an infinite game. We just got to stay in the game. So I realized there's no winning in this game, but I did realize that you can, lose in terms of losing money. And I hated losing money. I hated every day we had to present our P&L, and I loved being the one that was making money whilst everybody else was losing. And I hated a day where I lost money. I absolutely hated it, even though it's going to happen. Of course it's going to happen, and it was just like, what can I learn? What can I learn? And as I said, just treat it as a learning process. And I think if you can treat losses as a learning process, if you can learn from them, then it's not a problem. What I do have a problem with some trading styles is where people will just take losses again and again, and they can never learn from them. I find that quite, I wouldn't be able to do that. I wouldn't be able to use a method like that. I'd need to figure out what it was so I could either correct it or not trade that particular circumstance next time, like avoid it, basically.
The concept of just, well, this is to mitigate risk, this is for profit. Those are almost like mental constructs. They're all the same thing, right? Every time you exit some, you mitigate risk, even for the ones that you say are to take profit, right? They all mitigate risk, and they all book profit, right? So there's I think maybe go back and take a look at, you mentioned like 2 points was a good place when you first started, like taking scales and whatnot. What was it about the market generated information at the time that made 2 points a good place, right? You could even go into, are you familiar with MAE and MFE data?
Of course.
Okay. It's just some of my favorite data points out there, man. You can really start to get a sense of, over the life of a trade, how much heat did I need to take in order to see it? Forget what you actualized, right? MAE, MFE is not about, it doesn't matter where the P&L ends up. It only matters during the course of the trade, what was the most it went against you. Think of it more so in tick terms, like the actual units of the market rather than the dollars and whatever P&L. How far did it go against you? How far did it go in your favor? And then ultimately comparing that with exits, how much of an exit at any given tier or you know, in thirds or whatever you're doing there. You can start to say, wow, look at, I'm taking off a third of this position very frequently around, for trades that work, and a lot of your trades work, around 15% of the max favorable excursion. I would tell that trader they might be leaving a lot on the table for that initial risk that they took, just hypothetically, right? So look into data, look into yourself, look into market generated. I'm a fan of being as dynamic as possible because volatility conditions are constantly changing in markets. Sure. And so I always try to encourage people to look past fixed numbers. And the other thing I would say is, you alluded to at the beginning of this conversation about how much you hated seeing that nice open P&L disappear, right? I have found that most people fall into one of two camps in terms of which of those things trigger them and that they hate more.
Okay.
Some people, like yourself, hate more an open profitable position that comes roaring back and it all disappears and maybe you even take a loss on. Can't stand it, right? I've read some trading books and they say never let a winner turn into a loser, blah, blah, blah. Hate it, can't do it. Other people, such as myself, actually can't stand when I, let's say, trail a stop, right? Like you might, or take more off along the way, and that baby runs to that target that I knew I could see it doing, and I'm not in there holding any position anymore because I emotionally flattened out or whatever. I hate that worse than open P&L disappearing on me. Today in my crude oil trade, I kid you not, brother, I have zero stress, zero. It was a lot of open P&L. No regrets. I really don't. That trade could have easily gone 5x of where it was. And that's what I was going for. And it didn't work. So, you know, didn't make anything.
Yeah, very interesting.
I find that most people are pretty easily strong. It's like, are you left eye or right eye dominant? You know, like which of those do you hate the most? And then I think it's okay to structure some trading around giving yourself the most joy and least pain based on your natural makeup and aversion for that.
Well, like you mentioned Dogecoin earlier, I mean, that's a classic example. So people buying, here's a coin that was, it was started as a joke. I mean, literally, the guy who invented it thought it was a joke. And then people are buying it for, I don't know how many billions it was worth at some point. And I remember hearing somebody on New York Times has this podcast, The Daily, which is, I recommend, it's a good podcast. Anyway, so one time I remember hearing some guy who became a Dogecoin millionaire. And he was a guy, hardworking guy, whatever he did, I forget. He had no money. He never had any money. And then he had built, he had gotten to the point where he had this multiplied his Dogecoin position like to $1.5 million. And he had enough now to pay for his house and, whatever, and finally be comfortable and whatever. And the interviewer was asking, what are you going to do? What if it goes down? He started buying more. He was just, and I swear I was listening to this on one of my walks, and I just felt, I should get this guy's number and call him and just tell him, do yourself a favor and take some money off the table. It's probably not going to. And of course, he, I don't know what happened ultimately, but I'm sure he lost it all, or So that's the type of thing that these things can work for a time, but eventually they'll be wrong.
Yeah. It's very interesting because I know the exact podcast you're referencing, and I know that exact line because it was almost haunting to hear him say that if it goes down, he's just going to buy more. When you realize you've won for where you were at in life to where you are right now, if you just hit the exit, you've won.
Yeah.
And
take money off the table is actually it's actually a good principle in general. This is a case where it was something that was worthless that went up, but basically the idea of if you get ahead on something, take some off. You don't want to keep on riding the whole thing. And scaling out of positions is something that a lot of market wizards do. That's how you trade. And scaling in also sometimes. So the idea is not to do everything. You don't want to make everything depend on you're never going to get the top of the market and the bottom of the market, right? Except by extreme luck. There's only one fine point where that's true. But you can get the vicinities of highs and the vicinities of lows. And if you're scaling out, then you may not get the exact top, but you'll do pretty well overall. And so when markets go in your favor by a good amount, take some profits, raise stops so you don't end up giving it back. Very important to don't think of it, it's the market's money. It's the market's money if you let it be the market's money, but it's your money right now. Paul Tudor Jones said, basically every day he looks at all his positions. He said, would I still be in this? If I just put the position on, would I still be in it? Forget what I've made or lost, what I've made on it. But would I still have this position now? So you have to have that mindset. And if you're not comfortable having that position now, then you need to take some of it off.
The all-weather trader concept really is, to me, is look at different time periods, look at different strategies and indicators, look at different markets. And when you put them all together, what you're doing is smoothing out the equity curve. It's no different than being your own fund of funds, sort of, where you hire a bunch of non-correlated strategies and different markets, and you put them all together to create a smoother equity curve. So that's kind of where I'm at now. And I continue to think about ways I can smooth that track record even more. A friend of mine, Lawrence Bensdorp over in Portugal, has a great saying that I just give him full credit for, but I copy a lot, is filling the potholes. Your track record kind of goes up the page and has some potholes along the way, drawdowns. It's another name for them. And the more you can squeeze those out, the easier the ride is. And I'm all about return to risk and, trading in an easy fashion, not getting stressed out over everything and emotionally drained trying to deal with trading. It doesn't need to be that difficult.
It's an opportunity. I keep pointing to my trading screen. It's an opportunity making machine. It's going to be here forever. It's been here forever, hundreds of years, or some odd hundreds of years. Will you be here? And I think the whole game is just be there. Even if you're in the minor leagues, you eventually will get yourself in a position where you can bat and hit the 90-mile-an-hour fastball consistently. And you know how to lay off the curveball because you aren't any good at it because your coach, free coaching at Top Step, or your own personal mentor, your trading buddy, or your own self taught yourself to say, lay off the curveball, Michael. That's the lowest probability trade, so to speak. Find out what you're good at. Windows of opportunity. I was never good on Friday afternoon. My head was probably already in the weekend. Tuesdays and Wednesdays, Thursdays are my sweet spots. And then find your trading routine, prep, trade, and then reflect on it.